Last, we turn to the most interesting of these three most common non-GAAP adjustments, and that is non-recurring items. Non-recurring items are really a cluster of a variety of types of activities which analysts exclude from the income statement. So there are actually three broad types of activities that even GAAP wants you to basically present separately from the rest of the income statement. Those three types of activities are discontinued operations, extraordinary items, and accounting changes. Discontinued operations are gains and losses from operations that a company has discontinued. When a company discontinues or sells off a distinct part of its business, the income and expense from this part of the business, as well as severance, facility closure expenses, all will be recognized below net income in a separate category. So if there is any revenue during a particular year from an operation that is all of a sudden now deemed to be discontinued and that will presumably be sold down the road, that revenue, the associated expenses, all of that are actually separated out of the main income statement and recognized as just one net line, net loss or gain from those discontinued operations below net income. And that's the same from a GAAP presentation as well as from an analyst presentation. The discontinued operations are generally treated separately from the income statement, causing no problems for us in terms of analyzing earnings per share or profitability or things like that. Same goes for extraordinary items. These are things like losses from the expropriation of assets or accounting changes. So for example, if a company changes its accounting method for depreciation or inventory accounting, let's say they switch from LIFO to FIFO, the corresponding expenses on the income statement would change. Under GAAP, any impact on the income statement, on expenses associated with changes in accounting and accounting rules or assumptions, those changes have to be identified separately below the income statement, making it easy to compare this year's income statement to the prior year income statement without the noise of those changes, which do impact the year-over-year comparisons. For the above activities, the three that we just talked about, discontinued operations, extraordinary items, and accounting changes, FASB and analysts are generally in agreement. As long as we report them net of taxes as a separate line below net income, it doesn't muddy the waters of ongoing profitability. And where I'm going with this is that there are some activities where FASB and analysts are in disagreement. Before we get into line items where FASB and analysts are generally in disagreement, where the GAAP-based presentation is different from how analysts want to see these items, let's look at what Walmart's income statement looks like. And we see that Walmart, in line with the GAAP rules that we just talked about for discontinued operations, identifies that the net gain or loss from operations that they've deemed to be discontinued is presented distinctly from the rest of their continuing operations. So we have Walmart's revenue, cost of goods sold, interest expense, taxes, all the way down to continuing operations. Notice this line item called income from loss of continued operation, from discontinued operations, represents a net aggregation of revenues, net of expenses for entities that are no longer lumped into revenues and expenses here. And so the reason why analysts and FASB is generally in agreement about the right treatment for this is analysts don't want to look at the noise. The other option was to identify the income and loss from discontinued operations and bury it within these line items, to have revenues be a little bit higher, presumably because discontinued operations were generating revenue, and have costs and expenses a little bit higher because there were discontinued operations with some expenses. But rather take all that out and just net it as a separate line item. That's what FASB wants you to do, and that's what analysts want to do. They want to look at core ongoing profitability and basically look at this as something that's already done, that's not going to be recurring in the future, because next year these operations are going to be presumably discontinued.